Our next guest warns stocks are in a danger zone and thinks investors should avoid the recent winners. Julian Emanuel is Senior Managing Director at Evercore ISI. Julian, good to see you here in person.
Great to be here.
What's going on here in the market? You think this is just foolish?
This is about as complex an environment as you'll ever see, okay? So you go back to December when everyone knew the seasonality was going to be bullish for stocks, and the market tanked because we had tax loss selling that was epic. It was on a par with the liquidations we saw in March of 2020, and we all know what a great contrary buy signal that proved to be. That's when we decided to take off our recommendation that you have index hedging in place, and we transitioned to this idea that the likelihood, as it usually is that last year's losers end up being this year's winners. It's just that we've seen it on a scale that no one expected these first 2 weeks. Now, can it continue to run? History says you could get an entire quarter of that. We don't think that's likely, so that's the short-term setup. The medium-term setup is that we are, in all likelihood, because of the tightening that's already in the pipeline, because of the Fed's desire to get unemployment towards 5%, likely going to have at least a mild recession at the end of this year or early next. And that's the headwind for stocks. For us, that's the opportunity in thinking about options now because the VIX is way too low for that reality. And then the long-term picture is ultimately, if we do get the sell-off that we expect, you're going to get the new bull market buying opportunity that, frankly, we've been waiting for over a year now.
So does that mean you want to be positioned buying this sort of value-oriented stuff now and short or waiting on the high flyers that have run a lot and then flipping later if what you expect happens? So
we wouldn't chase the high flyers here. They've already moved a very long way. You said it yourself, their names. They could keep running, but risk reward looks increasingly poor with a VIX at 19 and a Fed on February the 1st that's going to remind us all that interest rates are going to go up again at least once, maybe 2 more times after that, because the CPI, yes, it's great, it's come down, but it's still over a 6 handle. And all of those are medium-term headwinds. So for us, staying with the value trade, consumer staples and healthcare, they actually work in an environment that is called stagflation. But when inflation is coming down, that kind of stagflation can actually deliver positive equity market returns.
Twice last year, the VIX was flashing green to buy stocks. It happened in June. It happened again in October. The VIX was about 35 or so. I don't know what happened last week, but that precipitous sell-off in the VIX was alarming to me. People look at that as bullish. I think you're pointing out that it's anything but.
No, it's definitely cautionary. Look, there was an element of, call it gamesmanship around the 3-day weekend. Very clear that downside protection right now is really not, terribly valuable in an environment where professionals continue to be somewhat underinvested. But the closer we get to that Fed meeting, the more we think that protection in your portfolio makes sense.
All right, Julian, we've got to leave it there. Thanks so much. Good to see you.
Thank you.
Emanuel, Evercore ISI. Tim, what do you think?
I think the dynamic around the VIX is what also concerns me here. It's counter-trend indicator. You can't have. We had Friday. We came in here. We were talking about this VIX. That almost got below 18. No way. But I do think that this dollar dynamic. Julian and his team have talked about this, and Evercore's talked about even a V-shaped bottom in what's been going on in China. And if you look at the charts, and I think this is kind of their call. I think you're getting that. I think the dollar dynamics are really important because as much as we had an 18-month dollar rally, another conversation I had with Julie even before we got on air was it's his view that we've had an 11-year rally in the dollar. That is over. And if you really have that, it's a major time for international investing. It's a major time for EM because your FX and EM is usually 50% of your return profile, and international is probably 25 to 30. I think we have that backdrop here.
Yeah, and Karen, you're actually touting international.
Yes.
One country in particular in your acronym.
Mexico, if I recall.
Yes, correct. CWW.
Nice.
You.
Yeah. It's not the greatest, ticker, but I think that the backdrop sets up well, and I think that deglobalization is what I talked about as part of the fundamental sort of thesis there, that they're going to be the beneficiary of that if they can just sort of get it together, which I think we have a reasonable chance of them doing, and I think the peso will appreciate. That's good as well.
I think consensus is obviously mild recession / soft landing right now. And here's the thing, where rates where they are and where they're expected to be and where QT is expected to maintain this year, I just don't know how that's a good investment environment for anything other than what, Julian just expressed to us right now, because we still have a lot of stocks, a lot of sectors that trade at really fat multiples with a lot of headwinds to growth, or at least getting back anywhere near the sort of growth levels that justified those evaluations when rates were much lower a few years ago. So to me, I'm still left scratching my heads here, but I think there's going to be opportunities to buy names, but you want to buy them when they're down and out, not when they're up 30, 40% in 3 weeks.